Okay. Good evening, students. Welcome to the session. So we were on the assessment of the various entities. We are on the last part. Today we will be finishing off this particular topic. So have you revised it? Yes or no? I'm assuming you have or not. Yes, have you revised it? We are almost on the verge. And today we will be finishing off this important topic as well. Yes, tell me. Have you revised it, guys? Okay. Any which ways, let's get started with it. So, what we have done in the last class was pertaining to the REITs, and then we had done for the different kind of partnership firms. We had done how the partnership firms are assessed. For the AOP taxation also, we had done that. Any questions if you have so far around that? Any questions, any doubt in regard to the AOP, BOI? Yes. Okay, if there are no questions, let's get quickly started. So now what we are going to start with is, we are going to move towards the alternate minimum tax. Like for example, we had it for the minimum alternate tax for the company. For the other individuals, we have the alternate minimum taxes. Okay. Now, what are the alternate minimum taxes? That's more or less similar to what you have under MAT. Okay. So this is also similar, but MAT has certain number of specified adjustment. MAT starts with the book profit. The alternate minimum taxes start with the net profit as per the computation of the income tax, as per the computation under different heads of income only. So it's not like the MAT where you start with the book profits and then only make the specified adjustment. Here we do not have that kind of situation. So let's try and understand how this AMT works. So AMT is, as I said, similar only to the MAT only, that it kind of caps the tax rate so that it does not go below it, right? It does not go below it. But at the same time, why is it introduced? Is in order to prevent the tax avoidance by the entity to reduce their profit. Now, especially the MAT is applicable to the entities which are claiming the exemptions. The entities which are claiming the exemption. Now, if you notice that the entities which are claiming the exemption, what they would try to do is, they would try to lower down their tax liability to zero by claiming the exemption. And then they would not be paying, in fact, any taxes. So, in order to avoid that, this particular provision of AMT has been introduced. Okay. So, like the companies were avoiding the taxes by the reducing the tax liability, right? In the similar way, the entities other than the company are also avoiding it. Are we clear? Okay. So, let's get quickly started with the AMT. So, alternate minimum taxes. AMT. Okay. Now, under the alternate minimum tax, again, the tax rate is more or less same, which is 15% only as it was under the MAT. So, AMT is but only applicable to entities other than the company. Entities other than the company. Okay. Now, entities other than the company, if it is applicable, what is the tax rate? It is 15%. It is 15%. Okay. So the tax rate is same as 15%. For the IFSC unit, it is 9%. Like we have it under MAT. Okay. Now, how the MAT computation is done, and also there is one amendment under the MAT, which is what we will be discussing just now. Okay. So first, let's try and understand what is the amendment. For the cooperative societies, again, the tax rate is capped to 9%. The tax rate is capped to 9%. Okay. So this is the tax rate which is there, which is introduced as the amendment for the cooperative societies under the AMT provision, not the MAT, the AMT provision. This is for your attempt, which would be relevant. And we would be just solving for the cooperative society also few questions, or for that matter, we'll be discussing for the cooperative society also how their taxation is there. And as if you remember under chapter 6A also, we have still not covered deduction under ATP and ATPA. If you remember, that is pending. So that's what we are going to discuss today. Okay. So the tax rate for the AMT for the cooperative society is capped to 9% instead of the 15%, which is there under for the normal entities. Are we clear? So that is the amendment which is there. Are we clear? Any questions so far? Okay. Now, how is AMT computed? That is what we have to understand. So as I said, the AMT which is there is, sorry, this is 18.5%, not 15. Sorry, my mistake. This is 18.5% and not 15. Okay. So now understand one thing, that in respect of the AMT, how the AMT is computed. The AMT is computed in a way that first you start with the net profit. First you start with the net profit or the total income. For the purpose of the AMT, this 18.5% is levied on the adjusted total income. This is on the adjusted total income. So, if the tax payable on the regular income of any entity or individual other than a company, as per the normal provision, is less than the AMT, then the adjusted total income shall be deemed to be the total income of the person. And AMT will be 18.5%. Now, what is adjusted total income? Adjusted total income is your total income. That is your total income as increased by and deductions under section. These specified deductions are only added back. Number 1, any deduction under chapter 6A. Chapter 6A deduction other than section ATP. So ATP is not added. Whether all the deductions have to be added back, all the chapter 6A, even LIC, medical premium, all of that, the answer is no. Which are in relation to the income. In relation to the income. Meaning which kind of deductions? Example, ATIA, IB, IAB, JJAA, all of these deductions needs to be added back, which are under the heading C, deduction in respect of certain income. Deduction under section 10AA. Under section 10AA for the SEZ. And 35 AD investment allowance But this has to be added back after reducing the depreciation under section 32. Depreciation under section 32. So this is how you need to add back. And then you apply the 18.5% of the adjusted total income will be your AMT. Now, as I said, in case of the IFSC unit, this is going to be how much? 9%. And the provisions are contained in, also write down the section 115JC. That was 115JB. This is 115JC. The MAT was under 115JB. This is under 115JC. For the cooperative society, it is 15%, sorry. And for the IFSC, this is 9%. Okay. Now, the provisions of AMT are not applicable to the assessees opting for section 115 BAC or 115 BAD for the cooperative societies. So what are the deductions which are to be added back? All the deductions in respect of the income excluding ATP, 10AA, 35AD minus the depreciation allowed. And if I say here also that if the tax payable under the normal provision is less than the AMT, then my adjusted total income would be deemed to be the total income, which means that all the provisions which are there for the advance tax, for the interest, penalty, all will be applicable in the like manner. In the next year, you can carry forward the AMT credit and set it off against the normal tax liability. So where the AMT is paid in excess of the regular income tax, then the credit would be allowed to be carried forward and set off in the later year against the normal income tax, which is excess of the AMT, right? And the amount can be carried forward for 15 assessment years, same under the MAT. With respect to the AMT and foreign tax credit, it holds in the same way what was for the MAT and the foreign tax credit. But if you are exercising the option under 115 BAC or BAD, you will not be allowed the AMT credit. Okay. No AMT credit for 115 BAC or BAD. Finally, the AMT is not applicable if the adjusted total income is less than 20 lakh. So this should be, adjusted total income should be rupees more than 20 lakhs. This should be more than 20 lakhs. Otherwise, the AMT provisions will not be applicable. Any doubt? Is this clear? Any questions so far? Any doubts? Yes. Students, you are there with me or not? I'm not getting your responses. Yes or no? Shall we solve one question? Will you solve one question on this? Yes. Yes or no? Are you there with me? Okay. So let's solve one question. Yes. Okay. So just write it down. Write down the question. Mr. Roy has earned or Mr. Roy was engaged in the business of textiles. Mr. Roy was engaged in the business of the textiles and he had earned the net profit of rupees 45 lakhs during the previous year 22-23. Okay, 22-23. Or maybe you can just remove this. Instead of business of textile, maybe let's change this and let's incorporate the 35 AD point over here. Okay, let's incorporate 35 AD point over here. Is in the business of, let's say, cold storage, for which there will be 35 AD deduction, which is also applicable in this particular case. Okay. So he is engaged in the business of the cold storage, right? And he has therefore earned the net profit of rupees 45 lakhs during the previous year 22-23. Are we clear? Then the following particulars are given in relation to his business. The following particulars are given in relation to his business. So what are the particulars which are given? Let's write it down. He incurred the capital expenditure of rupees 80 lakh on purchase of land and building. On purchase of land and building, right? During the period Jan 22 to March 22. During the period Jan 22 and March 22 for the above business. Okay. Then, or maybe you can just put this amount as, instead of just 80 lakhs, put it, let's make it 190 lakhs. Okay. Then he has capitalized this amount. He has capitalized the amount in the books of accounts as on 1st April 22. The cost of the land the cost of the land is rupees. The cost of the land is rupees 120 lakhs out of the amount of rupees 190 lakhs. Okay. During the previous year, 22-23, he incurred the capital expenditure of rupees 45 lakhs for the extension or reconstruction of the building purchased. So he has done some reconstruction for which he has incurred the expenditure. Now, he has to claim the deduction under 35 AD, for which you will advise him as to what deduction he can basically claim. So he has commenced the operations of the cold storage or warehousing facility, and he has incurred the capital expenditure on the purchase of land and building during the period Jan 22 to March 22, which he has capitalized. The cost of the land is given. The cost of the building is known to you. He has incurred certain capital expenditure, right? And the profits. Okay, let me just make it more interesting for you. The profits, instead of this, okay, the profits from the cold storage has the following bifurcation. Storage of food grains, 16 lakhs. Storage of sugar, is 14 lakhs. And storage of edible oil is 31 lakhs. Okay, is rupees 31 lakhs. So let's make it this as 61 lakh. Also, during the year, we also earn some salary of rupees 20 lakhs for managing the cold storage of ABC Private Limited. He also had contributed to LIC tax savings FD, which amount to rupees 1 lakh. He had paid medical premium for his wife, rupees 20,000. So yes, how we would take into consideration. First, tell me what will be the 35 AD deduction in this case before we proceed further. So let's go step by step. First, compute for me what is 35 AD deduction. Yes, tell me. What will be the 35 AD deduction? Okay, let me also give you the bifurcation of the capital expenditure over here. So this 190 lakh which is there has the capital expenditure of 80 lakh for the food grains. 80 lakh for the food grains. plus 60 lakh for the sugar and plus 50 lakhs for the edible oil. 80, 60 and 50. Similarly, the cost of the land also has a bifurcation. Let's take it. 50 lakh for food grains plus 40 lakhs for the sugar and 30 lakh for the oil. Similarly, this 45 lakhs also you can take the bifurcation. 20 lakh for food grain plus 15 lakh for sugar and 10 lakh for the oil. This is the bifurcation of different businesses. Anarga, I need the amounts. I'm also putting few more adjustments in the question so that I can make it comprehensive for you. He also had a self-occupied house property which he had taken on loan. The interest on loan was rupees 3 lakhs. And this storage of food grains profit you can make to 60 lakhs. So your overall profit will be 105 lakh instead of 61 lakh. Let's solve it together. Okay. First of all, whether all three of the storage are eligible for 3580 deduction, whether all three storage facilities for food grain, oil, and the sugar is eligible for 3580 deduction, then Anarga, what is eligible and what is not eligible? Only food grains and sugar is eligible. Yes, good Anarga. So, in that very case, I will get only deduction for storage of basically the agricultural produce is eligible. So 35 AD can be claimed for food grains and for sugar. Storage of edible oil is not eligible for 35 AD. Correct? Okay. So now let's start with first the deduction. So I have two businesses, computation of 35 AD deduction. Okay. So food grains and sugar. And this will be my total. What are the profits from the specified business? Right? This is 60 lakhs and this is 14 lakhs. Total comes to 74 lakhs. Less deduction under section 35 AD. So what is the deduction? Capital expenditure incurred prior to 1/4/22, which is prior to commencement of business. Prior to the commencement of business and capitalized in the books of accounts other than the expenditure on land, excluding expense on land. Right? So for the food grain, it will be, what was the expenditure? 80 lakhs minus 50 lakh. So 30 lakh will be the expenditure. Similarly, for the sugar is 60 lakh minus 40 lakh. 20 lakh is the expenditure. This is 50 lakh. Capital expenditure incurred during the year. Capital expenditure incurred during the year. This is 20 lakh for the food grade. This is the repair cost plus 15 lakh for the sugar. This is giving me 35 lakhs. So if you remember, I'll take you to the notes of 35 AD specified deductions. If you remember how we used to compute it. See, 35 AD. Expenditure prior to the commencement allowed during the year in which assessee commences the operation, but the expenditure should be capitalized in the books of account. 100% of the capital expenditure, which is wholly and exclusively for specified business, will be allowed as the deduction. Are we clear? So here we have both the expenditure, the prior period, as well as the capital expenditure during the year will be allowed to me. So this will give me the profit of 10 lakhs and this will give me the loss of 21 lakhs. Now this I can set it off against this. So the balance loss will be 11 lakhs. Are we clear? So loss from the specified business can only be set off against the profits from the another specified business. It cannot be set off against the profits from the edible oil. It cannot be set off against that because that is not a specified business. So this can be carried forward and set off in the future years. Are we clear? This can be carried forward and set off in the future year. Now, what about the computation of income? Let's try and understand that. So, computation of total income as per the normal provisions. As per the normal provision. So first is income from salaries. What is the salary? 20 lakh. Right? Less the standard deduction, of course, of 50,000. So 20 lakh minus 50,000 standard deduction, 19 lakh 50,000. Clear? We do not have any other deductions which are available in the question, which are available for the salaries. Are we clear? Then, secondly, income from house property. This is my self-occupied property. So, net annual value will be taken as, or gross annual value will be taken as nil. Okay. Less interest on housing loan under section 24B. How much should I take as the interest on housing loan? How much should I take? 3 lakh? How much is available to me? Yes. What is the interest on housing loan allowed as deduction? Yes, students, fast. What is the interest deduction which is allowed? I'm waiting for your answer. Is this a difficult question? What is the interest on housing loan which is allowed as deduction under 24B? Entire 3 lakhs? Yes. Not getting any answer. So, interest on housing loan which is allowed for the self-occupied property, right? The amount of deduction shall not exceed rupees 2 lakh. The amount of deduction will not exceed rupees 2 lakh. Are we clear? So, in case where it is a self-occupied property, then the amount of interest deduction will be only rupees 2 lakhs. So, it will be restricted to rupees 2 lakhs. Right? Any standard deduction? The answer is no. So it will be nil and then restricted to 2 lakh. This will take it to 2 lakh. Clear? Then income from or PGBP, profits and gains from business or profession. So net profit from storage of edible oil. This is not a specified business. What is the net profit which is given? 31 lakhs. Less depreciation on building. So the building which is there of the previous year, which was how much? The building which was there for the previous year was out of year 50 lakh, 30 lakh was for land. So 20 lakh, right? Plus during the year he has incurred the expenditure of 10 lakh, so 30 lakh. So on this there will be the depreciation at the rate of 10%. So 50 lakh minus 30 lakhs plus 10 lakh on this 10% depreciation. So I'm not allowing the depreciation of the last year in this year. The building would have already been added to my WDV. So I'm just taking the it has not been put under the depreciation on that was not claimed in the last year because the business has commenced this year. So the last year capital items are now being claimed. The depreciation on that is also being claimed in this year because the business has commenced this particular year. Okay. So what will be my depreciation? 3 lakhs. Any other expense which is available over here, the information is not given. So this is 28 lakh. This is 28 lakh. Okay. Then whether we will take the specified business over here, the answer is no. The specified business loss will be carried forward. So your loss from specified business would be carried forward and set off in succeeding AY. So I'm not taking into consideration that thing. Then any other income from other sources, the answer is no. That is not given here. Okay. Then what additional information is given? Here. Directly the deductions are given. So we'll take that into consideration now. We'll compute the total income first. What is my total income? What is my total income coming to? 19 lakh 50,000 plus 28 lakh minus 2 lakh. 45 lakh 50,000. 45 lakh 50,000. Okay. Then less chapter 6A deduction. ATC 1 lakh. ATD 20,000. Right? These are the only deductions which are given. So 1 lakh minus 20,000. 44 lakh 30,000. This is my gross total income. And this is my finally total income. Okay. Now what will be my tax on this? Please calculate the tax for me at least. What will be the tax liability? Yes, Jacob, that's correct. 11,41,500 is the tax liability. Okay. So, but if you include the cess also, then 11,87,160, including the cess amount. You have to include the cess. Okay. Now, what you have to do is you have to compute also the AMT, because first we'll compute the AMT and we'll see whether the adjusted total income exceeds rupees 20 lakh. For the applicability of the AMT, we'll first check that as the consideration. Okay. So what will be my total income for the purpose of the AMT? My total income is 44 lakh 30,000. What did I say just now over here? Add the deduction under chapter 6A other than section 80P. So whether I will add all these deductions which are here taken up, ATC, ATD, should I add it back here for the purpose of calculating the adjusted total income? Should I add back? Yes or no? No, Jacob. We don't need to add back those particular deductions. Why? What did I say over here? Here, I said that deductions in relation to only the income which are under 80IA, IB, IAB, JJAA, which are included under section C of the chapter 6A, under section C of chapter 6A. So here, your ATC, ATD, these all will not be considered. So that need not be added back. The AMT is introduced so as to prevent the tax avoidance by the entities which are claiming these kind of exemptions or deductions, not the ATC and ATD deduction. So deductions which are only in relation to the income, for them, there is this chapter 6A deduction which needs to be added back for computing the adjusted total income. So here I will not add back chapter 6A deduction. Here it will be nil. Then I do not have 10AA. So here also this will be nil. Plus 35 AD minus the depreciation under section 32. So not entire 35 AD I have to add back. Why? Because even if I would have not got 35 AD, I would have still claimed depreciation like I was doing for the oil business, right? So not entire 35 AD needs to be added back. Now, what is the deduction which I have claimed under 35 AD? This amount, which is 85 lakhs, right? This 85 lakh I have claimed as deduction. So here I will add back 85 lakh minus the depreciation. Now, the depreciation on this 85 lakh only, because this is entirely representing my building amount. So on this, my depreciation will be at the rate of 10%, which is 8.5 lakh. So what I would add back is 85 lakh minus 8 lakh 50,000, 76 lakh 50,000 needs to be added back. So my total income will become then 1 crore 20 lakh 80,000. This is my adjusted total income. This is the computation of adjusted total income. So this exceeds 20 lakh, therefore AMT is applicable. Now what will be my AMT? At the rate of 18.5%. So 18.5% on this, 22 lakh 34,800. 22,34,800. Plus, I will add here the cess at the rate of 4%, after which my AMT will be 23,24,192. Now, what is the tax I am paying here? 11,87,160. What is the AMT coming to? 23,24,192. So, since the regular income tax is less than the AMT, the adjusted total income would be deemed to be the total income, and Mr. Roy will have to pay the tax of 23,24,000. Are we clear? And then he would be eligible for the AMT credit of rupees 23,24,192 minus 11,87,160. So 11,37,032 can be carried forward and set off in the year when the normal tax is payable. Are we clear? Did you understand this question? Is this question clear? Yes. Good question, Jacob. That do we need to pay the surcharge here? Yes, the income is exceeding 1 CR. So this is what the mistake we do make even in the examination, that we do forget the surcharge. So yes, the surcharge will also be forming part here. So here you also need to add surcharge. So add surcharge. Now tell me, what will be my rate of surcharge? What will be my rate of surcharge? Yes, what will be my rate of surcharge? Yes, quickly. What is the surcharge? 15%. Yes. So here the surcharge at the rate of 15% will also be applicable. So yes, Anarga, you are correct. So what will be my tax liability? 22,34,800 plus 15% and plus 4%. So that will give me 26,72,820. And my AMT credit will then become 14,85,660. Yes, Anarga, how 8.5 lakh is derived? Where 8.5 lakh you are saying? Where, Anarga? Okay, this one you are asking? This particular 8.5 lakh? This is the depreciation on building. What is the total value of building? 85 lakh only. So depreciation on that is 10%. So 8.5 lakh. Nagela, the AMT is mandatory, not optional, just like the MAT. Clear? Now, one more aspect which we are not looking at the moment here is 115 JC. Sorry, not 115 JC, 115 BAC. So here, what we also need to look at is that what would be the tax liability in case I opt in for 115 BAC. Now, if I have a business, I can opt in only once. And if I opt in, I can only withdraw once. I cannot go back if I have withdrawn. So I have to be very careful. This is not a year-on-year scheme which I can think about since I'm engaged in business. All right. So let's do a computation under 115 BAC. Let's see if that is beneficial. Because if that is beneficial, then the normal provisions, then I will not have the AMT applicable to me. Right? So let's calculate income from salary. What will be income from salary over here? Income from salaries, 20 lakh. Whether standard deduction allowed? Whether standard deduction of 50,000 allowed over here? Under 115 BAC? Yes, Anarga, the AMT credit is normal provision minus the AMT. That is how the AMT credit has come. Just like what we had it under the MAT credit. No, the standard deduction will not be allowed. Not applicable. So 20 lakh. Interest on self-occupied property. 2 lakhs. Is it allowed? Interest on self-occupied property, is it allowed under 115 BAC? Can I take 2 lakhs? Yes or no? No, Anarga, we cannot take it. This is also not allowed. Interest on rental property is allowed. Interest on self-occupied property is not allowed. Okay, so this is also not applicable. Then PGBP. The net profit from edible oil. What is the net profit? 31 lakhs. Whether depreciation is allowed? Depreciation on building is allowed? Yes or no? Depreciation is allowed or not? Jacob, the depreciation is allowed. The additional depreciation is not allowed. So depreciation of 3 lakh will be allowed. I will be allowed the depreciation. So what is the amount? Then coming to 28 lakhs. The additional depreciation is not allowed. Then net profit from food grains. What is the net profit from food grains? 60 lakh. Net profit from food grains, 60 lakh. Whether deduction under section 35 AD allowed? Deduction under section 35 AD allowed? No. Yes, Jacob, that is not allowed. But can I claim the depreciation here under section 32 on building? Can I claim the depreciation here? Yes or no? Can I claim the depreciation on food grains and sugar? Yes, Chekhov, we can. So what we'll do is, what is the amount of building addition? It is 50 lakhs. So 50 lakh into 10%, 5% will be the depreciation will be allowed. So 50 lakh into 10%. So 5 lakh. This will give me 55 lakh as the food grain profits. Net profit from sugar storage is how much? 14 lakh. Less depreciation under section 32 on building. How much is the depreciation coming to? 35 lakh, which means 3.5 lakh will be allowed as the depreciation. So 35 lakh into 10%, 3.5 lakh. So 14 minus 3.5, 10.5 lakh will be allowed to me. Now what will be my total income? 10.5 plus 55 plus 28 lakh and 20 lakh of salary. 113.5 less. Chapter 6A deduction. ATC, ATD, whether it is allowed. ATC, ATD allowed under 115 BAC. No, not available. So this also will be not applicable. So my total income will be 113.5. Now calculate the tax for me. What is the tax liability? Yes, very quickly. Yes, what is the tax liability under 115 BAC? What are the slab rates? So here up to rupees 2.5 lakh nil, 2.5 lakh to 5 lakh is 5%, which comes to how much? To 12,500, right? So 12,500 over here. Then 5 lakh to 7 lakh 50. It is 10%. So again, 5 lakh to 7 lakh 50 is coming to 10%, which is 25,000. Okay. So 25,000. Next is 7.5 lakh to 10 lakh. How much it is? 15%. So 7 lakh 50 to 10 lakh is 15%, which comes to 37,500. Then 10 lakh to 12 lakh 50. 20%. So that comes to 50,000. And 12 lakh 50 to 15 lakh is 25%, which comes to 62,500. And over and above 15 lakh is 30%. So in this case, what is my total income? 113.5, which means 1 crore 13 lakh 50,000. So what is the tax on this? Yes, quickly compute for me. What is the tax which is coming to? I've written the slabs for you also. Thirty-one lakh 42,500. Is it coming like this? No. Yes, Jacob. 31 lakh 42,500 is correct. Your earlier answer was not correct. Narela, no, not 35 lakh. Yes, 31 lakh 42,500 is the tax. What about surcharge? How much will be the surcharge? Surcharge will be at the rate of what? What will be surcharge? Yes, Jacob, you're correct. What is surcharge? 15%. Yes, because the income is exceeding 1 CR. Plus cess of 4%. So my tax will come to 37 lakh 58,430. Is it coming like that? For everyone, is it coming this much? Yes or no? Yes, Nagela, that is total tax liability. Yes, not the surcharge. I am saying the total tax. Is it coming this much? Yes, Jacob. So now if you see my tax under 115 BAC is higher than the normal provisions or the AMT also, because normal provisions were not applicable, the AMT was applicable. So that is exceeding this amount. So this amount is exceeding, right? So therefore, it is not viable to go for 115 BAC. I need to go under the normal provisions. Under the normal provisions, my liability is less than the MAT, than the AMT, and therefore the AMT will be applicable. Clear? Is this clear in this question? So you can write down, it is not beneficial for assessee to go for 115 BAC. He needs to pay AMT as tax as per regular provisions is less than the AMT. Okay. Fine. So this was a very comprehensive question for you, right? So that now you know exactly how the linkage is there. Correct? Okay. Shall we move on? Okay. So the next part, what we have to discuss now is the cooperative society. So just write down. We are done with the individual partnerships and everything else. Now we are moving towards the cooperative society. Now, with respect to the cooperative society, now that is also a person, right? The cooperative society is a separate person. Now, how the taxability of the cooperative society takes place? That is what we have to understand. So, in case of the cooperative society generally earn from its members only and from some, letting out. They have this small income. They are generally not the cooperative housing societies. Of course, they do not have any kind of income over and above from the members, from letting out of their maybe clubhouses, transfer fees, entrance fees, all of that they have. But the cooperative society can also be the agricultural credit society. There could be cooperative banks also. So they have different nature of income, right? So the cooperative society generally means a registered society under the Cooperative Society Act. Now, as I said, it is a separate entity. The profits of the business are taxed under the PGBP only, right? And they have this specific exemption under Section 80P. They have this specific deduction under Section 80P. Now, what is this deduction which is there? So this deduction we have not covered, as I told you at that time, that I will be dealing with this deduction when I will go to this particular chapter, because it will be relevant to talk about this at this point in time. So the income of the cooperative society is allowed as deduction under Section 80P. Deduction under Section 80P. Now the deduction which is there is 100%. 100% deduction is there in respect of the specified activities which the cooperative society carry on. Now, what are the specified activities which are allowed as deduction? So, those are specified under 80P only. And what are these activities? So, the activity is in the nature of carrying on the business of banking or providing the credit facilities to the members. I'll just list down here the activities which are considered for the deduction. Yes. So if you can see here, in case of a cooperative society engaged in carrying on the business of banking or providing credit facility to its members, cottage industry, marketing of agricultural produce grown by its members, purchase of agricultural implements, seed, livestock or other articles intended for agriculture for supplying them to members, processing without the aid of power of the agricultural produce of its member, collective disposal of the labor of its member, fishing or allied activities like the fishing activities which are there, the entire profits and gains from any of this business is exempt, is entirely allowed as deduction, not exempt, it is allowed as the deduction under section 80P. Okay. So the cooperative society, if they are engaged into any of these business activities, then they are allowed the deduction. Secondly, there is also the deduction in respect of the primary cooperative society. So in case of the primary cooperative society, this is for any of the cooperative society which is engaged in this business. But this is in case of a cooperative society which is a primary society engaged in supplying milk, oilseeds, fruits or vegetables raised or grown by its members to another federal cooperative society engaged in the business of supplying milk, the government or local authority, a government company, then again the entire business profits are allowed as the deduction. In respect of any other cooperative society, which is not engaged in any of these activities which are either specified in A or in B, right? Then in case of the consumer cooperative society, the deduction is allowed as 1 lakh. So any other society not engaged in above activities, deduction is rupees 50,000. In case of consumer cooperative society, it is rupees 1 lakh. This is the straight exemption which is given, right? Also, the deduction is allowed to a cooperative society by way of interest and dividends if it is receiving the income from any other cooperative society. So, if let's say, for example, the cooperative society earns interest or dividends from other cooperative society, if it has the investments with the other cooperative society and it is earning interest or dividend, then entire interest or dividend is allowed as the deduction. Entire interest or dividend is allowed as the deduction. So interest or dividend on dividend earned on investments with cooperative society, not the all interest and dividend, but the investments which are there with the other cooperative society and interest or dividend which is earned therefrom is allowed as the deduction. Finally, the last one which is there is deduction in respect of letting out, which is the rental income which is there. So the cooperative society, if it let out the godowns or warehouses for storage, processing or facilitating the marketing of commodities, then that is also allowed as deduction. So in respect of the letting out income which is there, or in respect of the rental income which is there, that is allowed as deduction. So rental income from letting out godown or warehouse, godown or warehouse for storage, processing or facilitating the marketing of commodities. And finally, the deduction which is allowed in respect of interest on securities and income from house property to the cooperative societies which are not the housing society. So in case of a cooperative society, right, where the gross total income does not exceed 20,000, the interest on any securities or income from house property is allowed as the deduction. So any income arising to a cooperative society which is in the nature of interest on securities or income from house property is allowed as deduction where the gross total income does not exceed 20,000. It should not be a housing society or urban consumer society or society engaged in transport business or society engaged in performance of any manufacturing operations with the aid of power. So for the small cooperative societies where gross total income is less than rupees 20,000, not being housing society or urban consumer society or engaged in manufacturing with power, right? Interest on securities and income from house property is allowed as deduction. Are we clear? Now the deduction which is there under section 80P is not available to any cooperative bank. The deduction which is there under 80P is not available to any cooperative bank other than the primary agricultural credit societies and primary cooperative agricultural and rural development bank. So the cooperative banks are not allowed any deduction. You can write down no deduction to the cooperative banks other than the primary credit societies and primary cooperative agricultural banks and rural banks. So the deduction under 80P is not available to the cooperative banks. Any questions so far? Any doubt, any question? There is also a deduction under section 80PA. Now this 80PA deduction which is there is available to the profits of cooperative society which provide assistance to its members engaged in primary agricultural activities. So if the business of the cooperative society is marketing of agricultural produce, purchase of agricultural implements, processing of agricultural produce, then the 100% of the profits are allowed as deduction. So this is allowed to the agricultural societies which are there, which is available only to the agricultural society. Okay, so I'll just paste it over here. So if you see the section, yes, where the gross total income of an assessee, which is a producer company, having a total turnover of less than 100 crores, includes profit and gains from eligible business. What is eligible business? Marketing of agricultural produce, purchase of agricultural implements, and processing of agricultural produce. Then the deduction which will be allowed to the assessee is the 100% of the profits. Right? So 100% of the profits is allowed as the deduction if the business is that of the eligible business. Okay? So this is for the cooperative society. Now, what is the tax rate for the cooperative society? What are the tax rates? We have done that. What are the tax rates for the cooperative society? Yes. Yes, very quickly. Let me see if you remember. What are the tax rates? Yes. Quickly tell me the slabs. We have done that. Yes. Yes, Jacob, yes. So, if you remember, very first class, we had done the tax rates for the cooperative society. What was it? This one. So, this were the tax rates which we had done. Less than equal to 10,000, 10%. 10,000 and less than 20,000, 20%. And over and above 20,000, 30%, right? So, these were the tax rates which are there. So, one second. Yes. So, normal tax rates are this. Then, what is the surcharge here? What is the surcharge for the cooperative society? So in case of a cooperative society whose total income exceeds 1 CR but is less than 10 CR, then the surcharge is 7%. So total income greater than 1 CR, less than 10 CR, 7%. Then if the total income is more than rupees 10 CR, it is 12%. Right? So this is what the surcharge is, right? What are the optional scheme which is there? We had again done that as well. So if you remember, okay, here we have written surcharge as only 12%. Here it should be this one. Okay. The optional scheme is there under 115 BAD, which is 22% is there, right? And the surcharge in that particular case is, in case of a cooperative society opting for 115 BAD, the surcharge is 10% plus cess of 4%. So 25.168% is the surcharge. Is the tax rate for the 115 BAD company, but that will have to forgo all the incentives. So there is an optional scheme under section 115 BAD, which is allowing you the tax rate of 25%, which is 22% plus surcharge of 10% plus cess, which is 25.168%. But you will have to forgo all the deduction under 10AA, additional depreciation, then scientific expenditure, 35 AD, any deductions under chapter 6A other than 80JJAA, meaning even ATP deduction, ATPA deduction will not be allowed. So if you forgo that, then you will have the tax rate, which is this. And you will have to exercise this option before the due date of filing the return of income. Plus here, AMT is not attractive, not applicable. ATP and ATPA not available. Okay. Are we clear? Any doubt? Surcharge is 7 and 12, Jacob, for the cooperative society. Yes, is it clear? Any doubt? Any questions so far? Okay. So society members, if they earn any income, there will be tax, right, Nagini? Yes, Jacob, there's an amendment in surcharge. Even with respect of AOP, I have to tell you that as well. So in case of AOP, we have already done that, right? AOP, we have done that. For the AOP also, there is an amendment. What is that amendment saying? In respect of the surcharge, in respect of AOP. So you can write down in red over here, where the AOP consists of only companies as member. Where the AOP consists of only companies as members and where the total income is greater than rupees 50 lakhs but less than rupees 1 CR, then your surcharge is 10%. Surcharge is 10%. And if it exceeds 1 CR, then it is 15%. But only companies as members if it is there. Okay. Clear? Okay. So shall we take a small break of 10 minutes and then we get back? Okay, let's take a break of 10 minutes. So next, students, we would do certain case laws, but before that, there's last topic which is there, which is on assessment of mutual concerns. This we have already done that while we were doing PGBP as well, but I'll just quickly revise. Assessment of mutual concerns. For example, the clubs which are there, right? Now, these kind of entities which are there, or for example, even the cooperative societies which are there is a principle of mutuality. What is the principle of mutuality? The principle of mutuality says that one cannot trade with one's own self. So let's say, for example, there are members and these members would contribute to the common fund, and this common fund would only be used for the members only. So the principle is that one cannot trade with oneself. So if I'm collecting the contribution from members in a club or in a cooperative society, and I'm using that contribution for the members only. Let's say I'm collecting some entrance fees and then I'm using it for the members only if they are, having some events. Let's say I'm having some charges which are there for usage of clubhouse. Then in that particular case, the members only are using the clubhouse later on and the funds are used for that only. So then there is no difference between the contributor and the one who is participating. So the contributor to the capital is being utilized for that participator also. So the contributor and the participator are the same. There is complete identity. So in that case, the principle of mutuality says that one cannot earn income from oneself because one cannot trade with oneself. So therefore, there would not be any taxation on the profits arising out of mutual operations. However, there is specific taxability. If you remember under section 28(3), if you remember under PGBP, there was a specific taxability. And what was that? If I take you to 28(3), principle of mutuality. We have already discussed that, right? So there, income derived by a trade, professional or similar association from specific services performed for its member. If it is a case of specific services, then there will be taxability or there will be the income chargeable under the head PGBP. So if a trade association, professional association, for example, we have the professional association, the Chartered Accountants Society, the Chartered Accountants Association, they collect the membership charges and then use it for the purpose of the benefit of the members only. So if that is the case, there is a principle of mutuality that they cannot be taxed. But if it's a case that if it's a specific service which is performed for the members, let's say for certain member, there is an event conducted and out of that some income is earned. So if that be the case, then there will be the taxability for the trade and professional association. Also, what section 44A provides is, section 44A is there. So since the surplus arising to a trade professional or the association during the process of this serving the common interest is not included in total income, the expenditure, of course, will also not be allowed, right? The expenditure is also not allowed as deduction because the income is also not included. So 44AA, which is there, gives the benefit of any deficiency which is there. So excess of expenditure over the income is allowed as deduction. Now that deduction will be restricted to maximum 50% of the income, which is half of the income. This is in respect of general services and not specific services, because any which way specific services income is chargeable under 28C. So therefore expenditure will automatically be allowed. So this is what you will have to remember for the mutual associations which are there, right? I'll just put it in that chapter also. Sorry. Okay. Now there are certain case laws in this particular respect. And what are these cases? Let's try and understand. Now the case laws which are there is in regard to whether the non-occupancy charges, transfer charges, for example, the societies which are there, the cooperative societies which are there, they charge these charges which are in the nature of, let's say, non-occupancy charges. Now, what is non-occupancy charge? These non-occupancy charges are basically the charges for the societies which levy it in case the ownership of a property has been transferred by the developer to the owner, but the unit remains vacant. If the unit remains vacant despite the ownership is transferred by the developer to the owner, then in that case, the non-occupancy charges are levied. Or that, let's say, for example, there are other kind of charges, let's say transfer charges, if the flat is transferred from one person to another, the common amenity charges which are there, if these are received by the cooperative society from its members, in that particular case, Supreme Court in Venkatesh Premises Cooperative Society Limited case had held that the doctrine of mutuality will be applicable. So all these charges which are there are collected from the members of the cooperative society, and these are used for the members only. And therefore, the doctrine of mutuality will be operating in between. Are we clear? Similarly, there is another question is whether the interest which is earned, let's say on surplus fund, let's say the funds are collected from the members. Now these funds are kept in FDs and the interest is earned on the surplus fund. But the FDs which are kept with the members only. Let's say there is a club, one of the member is a bank only. Now these FDs are kept with a member bank only. So whether in that case, the interest which is there, can it be claimed exempt? So Madras High Court in Madras Gymkhana Club case had held that the interest earned from fixed deposit of the where the surplus funds were kept, this does not satisfy the principle of mutuality. Here there is no commonality between the contributors and the participators. Here the additional income is earned out of the surplus money which is deposited, and therefore in that very case the principle of mutuality will not be available. Are we clear? Principle of mutuality will not be available in that particular case. Clear? Okay. Last point which is there now under this particular chapter, and then there is one big amendment which we have to discuss, is the tonnage tax scheme. Or maybe first you can write the decision's name here. These are there in your module also. Venkatesh Premises Cooperative Society Limited, Supreme Court. Entrance fees, non-occupancy charges, transfer charges covered by principle of mutuality. Madras Gymkhana Club, Madras High Court, interest on surplus funds not covered by principle of mutuality. Okay. Last one. Tonnage tax scheme. Now, what is this tonnage tax scheme which is there? This is in relation to the shipping companies. This is applicable for the shipping companies, and this is the optional scheme This is the optional scheme which is there under Chapter 12G of the Income Tax Act. This is the optional scheme which is there under Chapter 12G of the Income Tax Act, known as the Tonnage Tax Scheme, because this is based on the weight the ship carries, the tons which the ship carries. So now this is the optional tax scheme which is there. Now, what is this particular scheme which is there? Okay, there's one question. Can you explain the mutuality principle? Okay, I would again explain it, but let's first finish it off, the tonnage tax scheme which is there. Okay, so the tonnage tax scheme which is there, as I said, is in respect of the shipping companies which are operating. This is for the shipping companies which are operating. Yes, ready, I'm discussing the tonnage tax scheme only. Yes. So, what is this scheme about? Here, the qualifying company is the Indian company which has the place of effective management in India, or the company which has the place of effective management in India. So, Indian company or a company which has the place of effective management in India, and it owns at least one qualifying ship. Owns at least one qualifying ship. Main object is to operate the business of ships, or main object of the company is to carry on the business of operating ship. Main object is to carry on business of operating ships. And what is a qualifying ship? The qualifying ship is a sea-going vessel of 15 net tonnage. Sea-going vessel or vessel of 15 net tonnage, or greater than equal to 15 net tonnage, registered under the Merchant Shipping Act and has a valid certificate. Now, what is the tonnage tax scheme provide? This scheme provides that in case of qualifying ship, having net tonnage, qualifying ship having the net tonnage and amount of daily tonnage income if it is less than equal to 1,000, then the income would be ₹70 for each 100 tons. If it is greater than 1,000 but less than 10,000, then it is 700 plus 53 for each 100 tons exceeding 1,000. Exceeding 1,000 tons. If it is greater than 10,000 but less than 25,000, then it is ₹5470 plus ₹42 for each 100 tons exceeding 10,000 tons. And last, if it is exceeding 25,000, then rupees 11,770 plus rupees 29 for each 100 tons exceeding 25,000 tons. Tonnage means the tonnage of the ship as indicated in the certificate. So this is what the scheme of the tonnage is. So tonnage income is computed in this particular way. This is a specific provision and this is how it is computed. So this is an optional scheme which is there. It is not something which is mandatory scheme. Also, in respect of the qualifying ship, what is a qualifying ship? Sea-going vessel, which is or a vessel greater than equal to net 15 net tonnage. It does not include, it excludes or does not cover the fishing vessels, then factory ships, then recreational ships, ferries, then offshore installation, these are the ships which are not included. These ships are not covered. Or sea-going vessels where the purpose is to provide goods and services which are normally provided on land. So these ships are not covered. Or a qualifying ship used for fishing for greater than 30 days. So all of these are not covered. Okay. So it's tonnage tax scheme clear? Clear? Okay. Now I'll quickly tell about this principle of mutuality. What I was trying to say is that in case of the trade or professional or similar association, you can write here trade, professional associations. The principle of mutuality says that one who is contributing the fund, if the funds are being used for the same person, means the contributors and the participant are same, then in that particular case, the principle of mutuality will be there. That is, the profits will not be charged. So if it is a general activity, you can write down general activity, or let me make it here only. Okay. If it is a case of general activity, then income not taxable as per principle of mutuality, and expenditure not allowed as deduction. But what we get is here one second. Here we get the deficiency allowed under section 44A, which is restricted to 50% of income. 50% of income. In case it's a specific activity, as I said, that is chargeable under section 28(3) PGBP, which will be income minus expense. Clear? So the principle of mutuality is that there cannot be any, the participant and the contributors are one and the same. So one cannot trade with oneself. Are we clear? Hope this clarifies. Okay. Now, few more things, certain special rates of taxes. Which we have to cover now. Now, under special rate of taxes, certain we would be covering, of course, when we would be doing the international tax class, right? So at that point in time, we would cover it. So that we are going to cover any which ways which are applicable for a non-resident, that we will cover at the time when we have the international tax class. Okay. Now, what we are going to cover now over here is, see, the specific rate of tax which are given are under section 115 onwards. Okay. So 115A, which is there, is for the foreign companies and the non-resident, that we would cover in international tax class, which is on dividend, royalty and FTS. Then 115AB, which is there. Now, that is which is there is in respect of the offshore fund. That also we would cover it in the international tax class. Then we have 115AC, which is for ADR and GDR. That again, we would cover it when we would be doing the international tax class. But there is one more provision, 115ACA. Now, this is in respect of GDRs purchased in the foreign currency. This is part of this chapter, but I would not be dealing at this point in time because I would be taking it up when we have the international tax class, and we will do 115AC and ACA together because both are linked. Are we clear? Then we have section 115AD. Again, that we would be covering when we will have the international tax class, because again, that is for the foreign institutional investors. Fine. Then the next provision is in 115B, which is for the life insurance company, which I'll cover it now, which is a very small provision for the life insurance companies. So for the life insurance company, there is a specific provision which is there under 115B, which provides for a concessional rate of tax. Under these provisions, if the profit and gains are derived from the life insurance business, the income tax will be 12.5% on the income from life insurance business. So that will be 12.5%. And this income would not be subject to MAT. This would not be subject to MAT. And in case it is the income from non-life insurance business, then that has to be the profit and gains of the non-life insurance business would be the profit as per the profit and loss account prepared as per the provisions of IRDA Act, Insurance Act. But the adjustments would be allowed for the expenditure which are not allowable under 30 to 43B. Then any provision for diminution in the value of investment will be added back. Gain or loss on realization of investment which are not credited or debited will be added or debited. Then unexpired risk, any reserve is created, that shall be allowed. Okay. So this is only a small provision which is also there in your module. Then we have already done 115BA, BAA, BAB. We have already done for the manufacturing company, 22% rate, 15% rate, all of that we have done. We have also done 115BAC. We have also done 115BAD for the cooperative society. Okay. Then 115BB, which is tax on winning from lotteries, crossword puzzles, race from the race horses. All of these which are there are taxable at the 30% on gross basis, and no expenditure is allowed. Then again, we have the 115 BBC, all of this you will be doing in the charitable trust. You have 115 BBA, which is for the non-resident sportsmen, that again in international tax class would be covered. Okay. Now, next is 115 BBF, which is there, tax on income from patent. This, if you remember, we have solved a sum on this, and at that time I told you that under 115 BBF, if the patents are registered and developed in India, registered and developed in India. Okay, and in case the income includes any royalty, the royalty income on such patents this would be taxed at the rate of 10% on gross basis, meaning no expenditure will be allowed. No expense allowed. And the assessee has to exercise the option for this particular tax rate on or before the due date of the return of income. And where the eligible assessee opt for this by way of 115 BBF, then he has to offer it for next 5 assessment years. And if he withdraws it, then he would not be eligible to claim the claim this particular section for another 5 years. So this is optional. Need to opt before due date of ROI under section 139(1). If assessee opts, then assessee offers the income for the 5 assessment years. So where the eligible assessee opts for it, he has to offer the income for 5 assessment year. And in case he does not do that, so failure to follow, for next 5 assessment year, the assessee will not be able to go into this section. Not eligible to opt under section 115 BBF for next 5 AYs. Clear? What is the meaning of developed in India? Means more than 75% of the expenditure should have been incurred in India. Are we clear? And this is only available to the resident assessee. By resident assessee. This is not available to a non-resident. Okay, so this is again a very small provision. Any questions so far? Then there is one more provision which is there is under 115 BBG, which is income from transfer of carbon credits. Now, what are these carbon credits? These are basically to prevent the environment deterioration which is there. So every country has started introducing this provision of carbon credit. This is a permit which allows a country to produce certain amount of carbon emissions, and this can be traded. So it is a kind of a tradable certificate or a permit representing the right to emit a certain amount of carbon dioxide. So if these kind of permits are sold, then the income tax will be at the rate of 10% on the gross basis. That is under 115 BBG. The last provision what we are going to talk about is 115 BBH. This is very, very important for you. This is a new provision. Income from virtual digital asset. So if you notice, since last 4-5 years, cryptos were on boom and there was no taxability prescribed for it. Right? So now it has been provided that where the total income includes any income from transfer of any virtual digital asset. So if there is transfer of virtual digital asset, then the tax will be the rate of 30% on gross basis. Tax will be at the rate of 30% on the gross basis, meaning no expenditure other than cost of acquisition or loss set off is allowed. So no expenditure or loss set off is allowed. Cost of acquisition, yes, it is allowed as deduction. Now, what is the meaning of the virtual digital asset? So that has been defined. Virtual digital asset has been defined under, VDA has been defined under section 247A. And I'll put the definition for you. So if you see here, the definition of VDA is, it means any information or code or number or token not being Indian currency. This does not include Indian currency or the foreign currency. Generated through cryptographic means or otherwise by whatever name called, providing a digital representation of value exchanged with or without consideration, with the promise or representation of having inherent value or functions as a store of value or unit of account, including its use in any financial transaction or investment, but not limited to investment scheme, and can be transferred, stored, or traded electronically. So this, if you see, is kind of aligning with the definition of money, what you used to learn in class 12 or CPT in economics, right? Functions as a store of value, unit of account, right? So this is referring to the cryptocurrency. But the word uses not cryptocurrency, it includes, it's a very broad definition. It uses the term virtual digital asset, non-fungible token, or any other token of similar nature. Now, what are non-fungible tokens? See, these are called the NFTs in short form. Now, non-fungible tokens which are there, they have the underlying asset. These are the unique tokens which are there that exist on a blockchain. There's this blockchain technology, okay? Now, let's say, for example, Ronaldo has some t-shirt, a printed t-shirt. Now, one can develop an NFT for that, by which it is kind of representing a patented right over it. So there will be a unique digital identifier that cannot be copied, substituted, or divided, that is recorded on a blockchain. These are unique tokens that exist on a blockchain. There could be NFT for some painting. There could be NFT for a car, for any of the asset which could be there. And this will be now traded. So NFTs which are there, these are the assets that have been tokenized through the blockchain. So even that is covered within the definition of the virtual digital asset. And any income from this will be taxed in the hands of the will be taxed at the rate of 30%. Now, if you see, they have just given the tax rate. It is not very clear as to whether this would be qualified as business income or whether it would be classified as the capital gain. That is not very clear. Also, what the CBDT has done is, since this definition was very, very wide, so it was not very clear as to whether even the reward points or, the credit points which you get in Amazon voucher, or you get it through, say, for any website, right? When you use those reward points, whether you're getting those reward points, whether 30% tax would be applicable on that or not. So for that purpose, the CBDT has clarified that on the reward points, this will not be applicable. So maybe you can just write it down over here. Gift cards or vouchers vouchers that may be used to obtain goods or services on discount, obtain goods or services on discount, then mileage points, reward points on credit card, or any promotional program, incentives, right? That may be used to redeem or use, that may be redeemed or used to obtain goods or services. Subscription to websites or platform or application. Or applications. These are not covered. These are basically not covered. Are we clear? So now let's try and understand in detail what is the virtual digital asset and how does it work. So it is actually a digital representation of an item. Virtual digital asset does not just mean that there will be only Bitcoin. Right? There could be many more things into it. So in case of the virtual digital asset, here, if you see, there could be cryptos, there could be NFTs, there could be Bitcoins. Many things are covered because the definition is literally very, very wide, isn't it? So therefore, in that particular case, the government has kept the tax rate of 30% in order to disincentivize the assessees to carry on these kind of transactions. Government does not want the assessees to carry on this kind of transactions. Okay. And for that purpose, they have kept the 30% tax rate which is there. Now, one very important thing which is here to be noted is that, as I said, here it is not provided as to whether this will be business income or whether this will be the capital gain. There could also be income under 56(2)(10) because at the end, this is an asset. If it is received for less than monetary consideration or for less than adequate consideration or for no consideration, then in that particular case, there could be taxability under 56(2)(10). But for all of that, no clarity is being provided. No clarity is provided in that respect. So whether this is going to be business income or whether this is going to be the capital gain, that will be decided as per the normal provision. Because no clarity on that front is given. Are we clear? So globally, there is not much clarity on this particular respect as to how the cryptocurrencies or the virtual digital assets are to be taxed. So the major challenge is also to classify it, whether this will be stock in trade or whether this will be the capital asset. Again, that is not clear. So it is very, very important to first understand the inherent nature of the crypto. Whether this could be classified as currency or whether this could be classified as security or whether this is an intangible asset or whether this is in stock in trade, nobody has clear answer. For that, one needs to understand how the virtual digital asset derives its inherent value. What is the purpose of that asset? Whether the purpose of the crypto is or whether the purpose of the tokens is to buy any asset, or whether the purpose of the crypto is to buy or to pay for certain goods or services, or whether they are deriving the value from some underlying securities, or whether they are linked to some currency. There are different kinds of cryptos which exist in the market. So there is no one-side answer for that. So therefore, one needs to understand the nature of the transaction to classify it, whether it's a security, whether it is a particular payment for any goods or services, or whether it's an expenditure, in fact, it's kind of used as a currency, or whether it is the intangible asset or whether it is a stock in trade. Also, India has introduced the withholding taxes at the rate of 1%. So that will also be covered when you would be going to the TDS class in the coming days. So that will be again covered in the TDS class. But just to give you a linkage, there is also the TDS under section. There is a TDS under section 194S, which is at the rate of 1%. So any person who is responsible to pay any resident by way of consideration for the transfer of virtual digital asset will deduct the TDS at the rate of 1%. However, the threshold limit here is 50,000 in case the total sales or gross receipt or turnover does not exceed 1 CR for business or 50 lakh in case of profession, and in any other case it is 30,000. But this is what the TDS liability is. Are we clear? So there will be, as I said, there is amendment under 115 BBH. There is also amendment under section 56. Section 56 has been amended to include VDA within definition of property. So if it is purchased or if it is gifted for without any consideration or for inadequate consideration and the difference exceeds 50,000, then it will be taxable under 56(2)(10). However, if it is received from the relative, the same would not be treated as income. Okay. So 56, section 56. To 10 will be applicable. 56(2)(10 will be applicable. Are we clear? Any questions so far? Any doubt, any questions? Yes. Any questions? (115) BBF. Yes, so 115 BBF, which is there, is in respect of the eligible assessee, who means a person resident in India. It could be company, it could be firm, anything, Jacob. Okay. Is this clear? So this is very, very important. This you should remember. Of course, this will be again dealt with you in the TDS provision also, wherein there are certain FAQs by the CBDT also, which would be covered separately, but because those are specifically relating to the TDS provisions. Okay. Now, what lastly I would like to cover is, see, we have not covered some of the ICDS, so that I would cover it in this particular class, because some of the ICDS we had done till with PGBP only. Few ICDS were not covered, so that I'll just quickly cover with you. Okay. So ICDS. First is ICDS 1. ICDS 1, which is there, is in relation to the accounting policies. So what are the fundamental accounting assumptions? The ICDS provides that some fundamental accounting assumptions should be followed. And if there is a change, then that should be disclosed. One is going concern, that the person has no intention or there will not be any liquidation in the foreseeable future. The person does not have intention to discontinue or to liquidate the business. The person is going to continue his business. That we have to evaluate year on year. Consistency in the accounting treatment or the tax treatment and the accrual concept. Are we clear? So section 145 also, if you see, 145 provides the method of accounting. It provides that the income under the head PGBP or income from other sources shall be computed in accordance with the cash or mercantile system of accounting regularly employed by the assessee. So one can follow either the cash system or the mercantile system. And it gives the power with regard to the ICDS, with regard to the central government to notify the ICDS. Are we clear? Now, that's what the ICDS 1 says, that you will have to then follow the accrual system of accounting. And if you follow the cash system, you can go for the cash system of accounting. Okay. And if there is any change in the policies, in the accounting policies, then that needs to be appropriately disclosed. Further, ICDS 1 provides that no mark-to-market loss, M2M loss, mark-to-market loss will be allowed or will be recognized unless it is in accordance with the provision of the other ICDS. Unless in accordance with provision of other ICDS. So if you remember, in ICDS 6, we had seen that we had recognized, in fact, the mark-to-market losses. If you remember that, what was the situation where we had done that? I'll take you to that. So it was in the context of foreign exchange gain or loss. C. For the monetary item which was recognized on M2M basis. So you can write exception is ICDS 6. The exception is ICDS 6. For the monetary item recognized on the foreign exchange fluctuation is recognized on mark-to-market basis. So exception is under ICDS 6 for monetary item. Are we clear? So this is ICDS 1. Then we have ICDS 2, which is for the valuation of inventory. Valuation of inventory. Now, for the PGBP or income from other sources, if you have the inventories which are there, okay, this will be under PGBP, not income from other sources. So ICDS shall be applied for the valuation of the inventory. Now, what are the inventories here? Inventory means, inventory here would be the finished goods, the raw materials, as well as the work in progress. So any raw materials, any finished goods which are held for sale, and the ones which are in the process of the production, it covers all three of this. It does not cover the work in progress, which is covered under the construction contracts under ICDS 7. The shares, debentures of financial instruments, which is also separately covered for the ICDS on securities. Agricultural produce is not covered over here. Then machinery spares, again that is covered under the ICDS on the tangible assets. Now what does it provide? That the inventories will be valued at, so valuation is at cost or NRV, whichever is lower. Cost or NRV, whichever is lower. However, there is an exception to that. What is the exception? In case of dissolution of partnership. In case of dissolution of partnership, this we have done it already, right? Or AOP or BOI. In case of dissolution of partnership or AOP or BOI, whether or not the business is discontinued, whether or not business is discontinued, the NRV will be taken on the date of dissolution. On date of dissolution. Are we clear? Clear? What is the net realizable value? Net realizable value is the value which you would realize from the market. Are we clear? Now this cost or net realizable value will be done on item by item basis. On item by item basis. So where the item of inventory is relating to the same product line, have the same purposes or end users, or are marketed or produced in the same area, then you can club it. Then you can group together. Otherwise, if let's say, for example, I have footwear, I have then sport, and then footwear also I have sport shoe, I have sandals, I have heels, then you will do the cost or NRV for each of the item by item basis. Clear? Also, what is the exception over here is, this is exception 1. Second is the materials which are held for use in the production, the raw materials which are used. So raw materials will not be written down to NRV. So that will be carried at cost, or you can write raw materials to be valued at cost if the finished goods in which they are incorporated, are sold above cost, are sold at or above cost. So the raw materials will not be written down below the cost if the NRV is lower than the cost, or you can write it in this way, not to be valued at cost. Raw material not to be valued below cost. If the NRV is lesser than the cost, then raw materials will not be valued below the cost, where the finished goods are expected to be sold at or above the cost. Okay. Are we clear? Now, as I said, what is the cost here? What are the costs here? What is the cost of the inventory? The cost of the inventory will be your purchase price plus cost of duties and taxes plus freight inwards plus any expenditure directly related to acquisition. Direct expenditure for acquisition minus the trade discounts or rebate. Minus trade discount or rebate. So you will include the cost of, in the cost of the inventory, you will include the duties and taxes. So section 145A, which is there, you can make a reference here to section 145A. Which provides the same thing, that the valuation of the inventory shall be at lower of cost or NRV computed in accordance with the ICDS. So this year you can also provide a reference to section 145A. Also 145A provides that the value of the purchase and sale of goods and services and of inventory shall be adjusted to include any duty, taxes, cess or fee which is actually paid by the assessee to bring the goods to the place of location. To bring the goods to the place of location. So you can maybe write it this as well. Okay. So 145 provides this. Fine. Then what does the cost, or how do we value the inventories? How the valuation needs to be done for the cost. So in case of the cost of conversion for the WIP, it will also include cost of conversion will also include fixed overheads. Will include the fixed overheads plus the variable overheads. So fixed overheads which are there will be allocated and the variable overheads will also be considered. Fixed overheads will be based on the normal capacity of the production facilities. Okay. And what you would exclude from the cost? exclude the abnormal losses, then storage cost, admin overheads, and selling cost. These will be excluded. Right? These will be excluded. The valuation of the cost will be value, or the method to determine cost will be it will be FIFO or weighted average. You can use FIFO or weighted average cost formula. Are we clear? And you can, what are the techniques? You can use techniques for cost is either you can use standard cost or the retail method. Standard costing or the retail method. Standard cost will take the normal levels of consumption, and retail method can be used in the retail trade. Are we clear? This is ICDS 2. Then ICDS 3, which is there, is in relation to the construction contract. For the construction contracts. Now, this is also provided under section 43CB. Section 43CB of the Act also talks about this. Now, how the construction contract are to be taxed, or how their taxability is to be done. What is a construction contract? These are the contract for the construction of building, for asset, which are there, like which are big contract which run over a period of time. Right? Now, in case of the construction contract, the contract revenue will be contract revenue, which is there, will be recognized, shall be recognized when there is reasonable certainty, when there is reasonable certainty of ultimate collection. So revenue will be recognized when there is reasonable certainty of the collection. And what is the contract revenue? This will be the revenue amount, revenue as agreed in contract, any retentions, and any claims. Okay. So this will be recognized when there is a reasonable certainty that the revenue will be realized. Then minus the contract cost. Or you can write it like this. For the construction contract, the taxability will be contract revenue minus contract cost. So the contract cost will be the costs that are related to a specific contract, any overheads which can be allocated to that particular contract, right? That will be considered as the contract cost. So contract costs are the costs which are particular to that particular project, or the costs which are attributable for that particular contract. Now, this particular contract revenue and contract cost will be recognized on the basis of the percentage of completion method. recognized on percentage of completion method. That's what 43CB and ICDS 3 says. So this should be recognized by reference to the stage of completion of the contract activity. This is known as the percentage of completion method. Whatever you complete, up till that only you would be recognizing. So the contract revenue is matched with the contract cost till the stage of completion. The stage of completion, how it is determined, how much costs are incurred for the work which is performed up to the reporting date. It is based on sometimes the certificate from the architecture as well. Are we clear? So this is what ICDS 3 provide. Next is ICDS 4. Revenue recognition. ICDS 4 is revenue recognition. Again, section 43CB provides for it. This provides for the revenue arising from the sale of goods, rendering of services, sale of goods, rendering of services, and interest, royalty, or dividend. Right? In case of sale of goods, the revenue, it says, shall be recognized when the seller has transferred, the property, in goods to the buyer, or the significant risk or rewards of ownership have been transferred to the buyer and the seller retains no control over the goods, or when significant risk or rewards are transferred to the buyer and seller retains no control over goods. So, in a situation where there is significant risk and rewards are transferred of the ownership, then the revenue will be recognized at that point, or when the property in goods has been transferred. So, revenue shall be recognized when there is reasonable certainty of its ultimate collection. When there is reasonable certainty of its ultimate collection. Sorry. When there is reasonable certainty of ultimate collection. In case of where the reasonable certainty is lacking, for example, for any claims which are raised for the escalation of the price. Let's say I've raised the claims in a case where I want to raise the price now. Now, I do not know whether that claim would be sustained or not. In that case, there is no reasonable certainty. Or in case of export incentives, there is no reasonable certainty. Then the recognition will be postponed to the extent of the uncertainty involved. So in case of you can write down escalation claims, export incentives, revenue recognition, to be postponed till the uncertainty prevails, or to the extent of uncertainty involved. Are we clear? So, with regard to this, section 145B, which is there, section 145B, this is covered under section 145B. This provides that any claim for escalation of price in a contract or export incentives will be deemed to be the income in which reasonable certainty of its realization is achieved. Recognize when reasonable certainty of realization is achieved. Even in case where there is the income which is in the nature of subsidy, where there is income in the nature of subsidy, section 145B provides that the subsidy will be recognized as the income in the year in which it is received. So subsidy recognized in year of receipt. Recognized in the year of receipt. Okay. Then then the rendering of services. Again, the services which are there have to be recognized on, the services which are there have to be recognized on percentage completion basis. But here there is a bifurcation. So again, section 43CB talks about this. Section 43CB talks about this. Section 43CB also provides where the duration of the contract is not more than 90 days. Then in that case, contract for less than 90 days on percentage of completion method. Project completion method. Not percentage, on project completion method. And where it is less than 90 days or it involves indeterminate number of acts over a period of time, then in that case, where the revenue from the service contract with duration of less than 90 days may be recognized when the rendering of the services is completed. So if it is less than 90 days, then on the percentage completion method. And if it is more than 90 days, contract greater than 90 days, then in that case, under the straight line method. So revenue from service transaction will be recognized by the percentage completion method in this, then by the percentage completion method. So service transaction you have to recognize on the percentage completion method if it is more than 90 days. If it is less than 90 days, then when the contract is entirely completed. Are we clear? Under percentage of completion method, you match the revenue with the cost and you determine at what stage you have reached, and based on that you recognize the revenue and the cost. The same is in the case with the construction contract. But where the project is for less than 90 days, then in that case the project completion method, that is, you will recognize when the entire project is completed. Are we clear? Then interest, royalties or dividend. Interest, royalties or dividend. So interest will be recognized. Interest which is there, interest on any refund of tax. This shall be deemed to be the income of the previous year in which it is received. In which it is received. Discount or premium on debt securities. Discount or premium on debt securities. This will be recognized over the period of maturity. Amortize, or let's say not amortize, they recognize over the period of maturity. Over life of debt security. Royalties will be recognized as per the contract. Royalties as per the contract. And dividend as per the act. Dividend as per the act when it is declared, distributed or paid. Are we clear? So the revenue recognition is considered also under section 43CB, 145B. So 145B also talks about the subsidy, escalation claim and export incentives. Are we clear? So we'll stop over here. We have 5 more ICDS to be finished, but out of which ICDS 5 we have already dealt with, ICDS 6 we have already dealt with, ICDS 7 also we have done. So ICDS 5 which was there was for the tangible assets that we have done while we were doing the depreciation. So that we have already considered, but yes, some portion of it I may just consider very quickly in the next class. Then ICDS 6 which is there, foreign exchange, that I have completely covered in the depreciation. Then ICDS 7, government grants, is also completely covered in the depreciation. ICDS 8 and 9 we have to do, which is for the securities, and borrowing cost also we have completely covered. So what is left is only 8 and ICDS 10, which is for the provision, which we'll quickly cover before the next class. And till then, we'll just stop over here. So thank you so much. I do not see any questions, at least in the chat box. Yes. Thank you so much. See you in the next class. In the next class, what we'll be starting is the income tax authority. Okay. Thank you so much.